the more wealth you create as an individual, the
Mhm.
bigger the target on your back, right? And
Totally.
let's just use a simple doctor analogy here, because I think it resonates with a lot of people. If you
Sure.
become a doctor, you get a medical practice, you get multiple medical practices. People know you're pretty successful.
Mhm.
And before too long, someone's going to come and target you and try and sue you, rightly or wrongly, whatever.
Yep. Hey, what's going on, Cash Flow Hackers? It's Chris with Life 180, and I am here today with KC Chohan, who is the founder and CEO of Together CFO. And he's also an author for Forbes magazine, which is amazing. And so I just a little context here. I saw KC as a keynote speaker at an event that I went to, man, it was about a month ago now. And it was one of the most powerful presentations that I saw the entire event. And being that I do what I do in the world of life insurance and helping people invest for cash flow, and we're always talking about tax efficiency and so on and so forth, KC does a lot of talking around tax efficiencies, around trusts, around just making sure that we're giving less of our money to the government and keeping more of it for ourselves and our families and our businesses, right? And so I thought it would be really beneficial and valuable to have him come on here and talk about what he does and give some pointers. And ultimately, I have no idea where this is going to go. We're just going to have a conversation about all this, and he's going to teach, and I'm going to ask questions, and we're going to have some fun. So KC, thanks for being here, man.
No problem. Thanks for having me, Chris, and thanks for the kind words. It's really nice of you.
Absolutely, absolutely. So KC, one of the things that you talked about, I remember being on stage, or when you were on stage at the event, and I was watching you, and about maybe 60-70% of the way through your presentation, you were like talking about layering different trusts together, and then you're like you kind of had this thing, and you're like, so there's this one strategy, I don't sell it, I don't do it, but if you want to make it even better, you stack in life insurance inside of these things, and it makes everything even better, right? Like, you're talking about that. And so obviously that got me excited with what I do. Just to hear you say that, I was like, because I'm always looking for a tax guy, a trust guy that actually sees the value in what we do. And so the fact that you said that and you had no real incentive to say it meant to me that you understood like all this. And so I was like, I need to talk to this guy. And so that said, though, that's not what I want to really talk about in this video. What I want to, if you can, I'm gonna like turn the floor over to you, and if you can kind of talk to me a little bit about what do you do from a trust structure, and how do you utilize trust to help people mitigate their taxes, reduce their tax exposure, if you will. I guess that's probably the way to put it. And at what point in time do people really qualify to work with you, right? And because I know you have all sorts of different perspectives on the different types of trusts and who kind of fits where. So if you could you walk me through the journey of what that looks like? Because I think the idea of trusts is a very overwhelming thing. Like, I think a lot of people go, "Ooh, I want to do it," but then a lot of people just don't end up pulling the trigger because they just don't know what to do. They don't know where to start. They don't know who to talk to. They don't know if they qualify because their net worth isn't high enough, or maybe whatever. So
yeah, there's a whole gamut. Like, you're opening Pandora's box, and the full can of worms is coming out. But yeah, we'll dig into all of that. To
awesome.
start off with, I would just say that there's many different types of trusts, similar to insurance policies, right? You could get whole life, you could get IULs, you could get annuity. It just goes on, and it just kind of baffles people, and eyes glaze over, and it gets really confusing really quickly.
Totally.
So for the purpose of this conversation, let's just keep it really simple at the beginning. We're talking specifically about complex trusts.
Okay.
And that is different to 99% of trusts, 99% of trusts that people are used to or have heard of or even have set up. If anyone's got a living trust or a land trust, or any trust, usually is going to be set up by most professionals as a simple trust.
Okay.
That's not what we're talking about. We're talking about what the elite, powerful billionaires and wealthy families have done for multiple generations. And that's something called the complex trust. So that's the first distinction that I want to make off the bat, because when you speak to people and they're like, okay, yeah, I've got a trust.
Okay.
It's the same as when they tell you, yeah, I did an insurance policy 20 years ago. Like, there's levels to everything, right?
Totally.
And what programs were even available then are probably obsolete now. It's constantly evolving and changing. Less so in the trust world, but the point I'm trying to make is that 99% of what people have set up, or what we see, is a simple trust, and that's the wrong type of trust right from the bat.
Got it. So what would be a definition, I guess, of a complex trust, or how do you know if it's a complex trust, or how do you kind of get started going down the complex trust path?
It's actually quite funny what the definition of a complex trust is, because it means it's not a simple trust. So I'll answer the question in reverse. If you're not a simple trust, or don't meet the parameters of a simple trust,
sure,
then you are a complex trust.
Sure.
So the main one, there's 3 different parameters. The simple one is a simple trust can't make charitable contributions. It cannot it has to distribute all of the money in the trust, so to the beneficiaries, i.e. So it can't accumulate income, is the key thing.
So a simple trust cannot accumulate income.
Correct.
But a complex trust can.
Yes. And that's really the key kicker of what we're going to talk about in today's talk.
That's awesome.
So if you want to accumulate income within the trust, then you want to be a complex trust, not a simple trust.
Awesome. So how do you go about doing that? That sounds phenomenal, right? Like, to be able to accumulate income and then still get the benefits, the tax benefits and the protection of a trust, I assume.
Yeah, so there's levels to what the trust's going to do. A lot of that comes from asset protection. It comes from wealth transfer as well. So just by having the right type of trust and the right subsets and provisions within the trust, you're going to get a lot of these different benefits. But from a taxation standpoint, if you can accumulate funds within the trust, that's going to be massive. That's going to allow you to kick on and really compound your wealth creation, similar way that an insurance policy would.
That's amazing. So let me ask you this then, as far as the trust goes. So if I were building a business and I had income, would I want to flow all of my income through the trust?
Yeah.
And then have the trust pay me after the fact, or have the trust own everything in my life? What does that look like?
So yeah, we're jumping ahead into into deeper levels, but effectively, yes, the more wealth you create as an individual, the bigger the target on your back, right? And let's just use a simple doctor analogy here, because I think it resonates with a lot of people. Sure. If you become a doctor, you get a medical practice, you get multiple medical practices, people know you're pretty successful, and before too long, someone's going to come and target you and try and sue you, rightly or wrongly, whatever.
Yep.
By setting yourself up correctly within the trust world, you're taking that target and you're reducing it much, much smaller. So in the talk that I did at MD Live, we talked a lot about asset protection and kind of getting out of the public eye. Yeah. That can be done with a lot of different types of trust. You don't specifically need a complex trust for that. Okay. But the premise is the same. We want to take ourselves out of the firing line, because you've created a lot of wealth. You're going to get a lot of attention, sometimes the wrong attention. And just because you haven't set yourself up correctly, it means some random person with a grudge can come and take you for tens of thousands, if not hundreds or millions, just depending on what your level of wealth is. So the first thing is asset protection, right? Then when we get into later life, people want to talk about wealth transfer. I've made all this money. How do I pass it on to my wife and my kids in a tax-free way? Because if you don't do that, probate's going to kick in, and you could end up losing 40 to 50% of that estate of wealth that you've created for no good reason other than you didn't set it up right. So that's like the first two things. Then when we get into kind of the advanced stuff, is the byproduct of good estate planning is going to be tax efficiency, capital gains specifically, and annual business as well. So if you have a business that's creating a lot of cash flow, then you can structure that in a way where the majority of that money is going into the trust, And then in the trust world, there's different accounting rules, different taxation rules, where you can really optimize a lot of those funds if set up correctly and you follow the guidelines by the IRS.
Awesome. And so when it comes to owning a trust, then, you know, and running, obviously the higher net worth, the more complex it can become, the more assets and revenue you have kind of flowing through it, the more complex it can become, or maybe complex isn't the right word since it's called a more complicated.
It becomes like a spider web.
Yeah. So I always want to be really careful with my wording with this stuff. So in that scenario, let's say we have a husband with a wife and 2 or 3 kids, and you're running some businesses. Can you talk to me about somebody that maybe has $1 million plus a year of income? Like, what are the ultimate benefits, and how would that flow look like for me? Like let's just say I'm that guy, right? Like, I got a wife, 3 kids, $1 million of income. Like, what does that look like? Like, why do I want that trust?
Got it. Okay, great question. Good scenario. And let's just assume on that $1 million, you're paying 35% as a hypothetical number in tax.
Sure. Yep.
So that means on the $1 million profit that's coming to you, you're paying $350,000 per year in tax, which is quite horrific if you're not set up right. It's a lot of money, right? Totally. Going to pay for at least one of those 3 kids' college tuition.
Totally.
Who knows what it'll be by that time. Anyway. That's a different podcast for that one. Right?
Yeah, exactly.
So the types of trusts that we design are specifically for people that have over 100 to 150K in tax liability every single year. Because of the complexity of creating it all, getting it set up, making sure it's ran efficiently, it's not for everybody. If you're below that or close to that, then there's a lot of other loophole level stuff you can do, a lot of which I spoke about on stage, whether it's buying assets and depreciating them, or looking for whatever the government is pushing, whether it's bonus depreciation, whether it's easements. You know, there's been plenty of things that have come and gone, and that cycle will just continue to go. So depending on what time anyone's watching this, who knows what the latest loophole is, but we're talking about something completely different to that, because once you create a structure, it's going to be there forever and it's going to be multi-generational. So the way to think about this is you're going to create it not really for you, but for your future generations.
Love it.
So it really ties well into insurance as well, because now in the trust world, you get to use insurance as a deduction, whereas in the regular LLC, S Corp, C Corp world, you don't always get to do that. On the off chance, you could probably get away with doing a key person insurance policy, but you could quickly tap that out. And if you're making $1 million of net profit every single year, then how much of that can you dedicate to a key person insurance policy? You need something more robust, but then also more flexible. And that's where the trust structures come in, because you can send that money rather than it coming to you as an individual, as Chris, the husband, the father, the business owner. It can go into the trust structure, which is the Kirkpatrick family structure, and not so much you as an individual. And that's really where you'll get a lot more benefits from it.
So is this what all these family offices are doing? Ultimately, they're putting these complex trusts in place. They're utilizing life insurance, putting it in there. It creates this generational wealth kind of opportunity. They create these rules and systems inside of the trust to make sure that everybody's managing the money properly and all that. Like, can you give some insight into that at all?
Yeah, it definitely is. This is very common in the right circles.
Yeah.
And a great example of this was back when Ted Kennedy ran somebody over, and
that's not good.
Yeah, he caused a crash and they came after him, but he didn't own any assets, so they couldn't get any cash from him. So as tragic as that example sounds, the asset protection of the trusts is really what I'm trying to point out. I'm not condoning running people over or committing anything illegal, just to be very clear. But I'm saying that if you don't own anything as an individual, people are not able to sue you, or they are able to sue you, but they won't because there's nothing to get.
Yeah. So
So
you're able to do that though. You're able, like, so for me, I'd be able to have all my everything go through the trust, and I still control the trust.
Yes.
And can handle all my personal life expenses, business expenses, all that stuff through the trust, and still control it and not have any of the ownership on me personally. So I'm not exposed to liability.
Absolutely. Within reason, you can't just go to Vegas and go gambling and say that's a trust expense.
I'm out. That's not.
Yeah. You got to stay within the rules and guidelines. But yeah, we help guide all of that. But generally speaking, when you're living in the trust world, as opposed to you as an individual or through LLC, S Corp, or call that a business entity level,
yeah,
the rules are very different at all three levels. So you get a lot more benefit within the trust world and privacy, security.
Love it.
Compared to individual, compared to business entity level.
Okay. So this sounds, no pun intended, but it sounds more complex than most people would think about a trust. Like, so I think most people that I've ever talked to about a trust, kind of their interpretation of a trust is, I'm going to get this trust, I'm going to put my assets in it. And then it's kind of a set it and forget it kind of mindset. But what I'm hearing from you is that it's very managed entity, if you will. It's its own entity that has to be managed very actively, right? And so can you kind of break that down and talk to me about, is that one of the things that like your firm does, is helps manage these components? Because that seems like it'd be an animal on its own, right? Like just a
and it is. It's very involved at the beginning once you're setting it all up and getting it going, and ultimately you're learning a new set of skills here, right? So to think you could come into this world, learn everything overnight is a little naive, right? You've got to be taught. And what we do is we teach you how to fish rather than just give you a fish. We can easily give you a fish and away you go, but really the whole multi-generational aspect of what we do is teaching you so you can then teach your future generations and they can teach their future generations, keeping your family all together and working as one rather than fragmented as individuals.
Okay. That's awesome.
Yeah. So when you look at the Rockefeller family as a simple example, and you compare that to the Vanderbilt family, and you
the tragic comparison,
but it's real, right? Is that if it comes down to a lot of core values, ethics, there's a whole host of factors, but just from the standpoint of let's stay together, keep our wealth together, and make decisions together as a family unit versus here's 5 million, here's 5 million, here's 5 million. Maybe one kid's going to really succeed and make 5 into 50. Maybe the other two not. Maybe one's going to just keep the 5 solid forever. Maybe the third one's going to lose it all.
Or maybe like the Vanderbilts, everybody would be out of money pretty much within 100 years.
Yeah. So usually that's what happens. It'll all get lost. So we're here to try and prevent that, but to educate people and say, as an example, let's use the scenario that you mentioned where you've got 3 kids and maybe one of them's financially savvy, the other 2 aren't. You could do a lot of things with insurance products to make sure that the 2 that aren't so financially savvy can have a steady stream of income coming in from insurance products, investments, and other things that maybe one of them doesn't need because he or she's a good real estate, let's say, and they want to invest in that. So getting the family unit together and knowing how you want to make that succeed at your level, at the wife's level, at the kids' level, at the grandkids' level is really important. And that's all done within the trust structure, and it quickly becomes a spider web of trusts to support the family as it grows, and ultimately to help you kind of get out of the system, as it were, that the elites don't play in. So if you look at the elite families, they don't play in the same systems as the majority of the 99% of the world, right?
Yeah, totally. You actually use, this is funny, like now that you're saying this, it reminds me of what you were talking about on stage about Jeff Bezos. Was it Bezos and Buffett, or was it Gates and Buffett?
It was Gates and Buffett. Yeah.
Okay. Can you tell that story real quick? Just because I thought it was just mind blowing to me.
So yeah, so Warren Buffett and Bill Gates have been long-standing friends for many years, sat on each other's boards for foundations and what have you. And then when Buffett made the pledge, all these billionaires are doing this giveaway pledge of 99% of their wealth. It's all a bit of a joke, really, because what they are doing is they're donating the funds to each other's or their own 501c3s, which technically the wording on what they're saying is correct because they're giving their own money to a charity. The part that they're not telling you is that they fully control that charity. So I think in the example that I spoke on stage, Buffett had donated 32 or 34 billion to the Bill and Melinda Gates Foundation. And then the very next day, they went back and invested that same money into Berkshire Hathaway. So it's just all musical chairs and they're just moving them around.
But that can all be done.
All legal, all public knowledge. You could Google it right now and it'll come straight up. So people don't see what's right in front of them.
Yeah.
And recently, ProPublica did this great article that I mentioned in the talk where it exposed billionaires' true tax rates. They then did Pandora Papers leaks, and they've done a whole host of amazing stuff when it comes to what is it that the billionaires and the elites are actually doing with their taxes. And more importantly, what we do is we take those same structures and we give it to successful entrepreneurs, maybe the next tier down of people that are successful, have made some money, but do not have that same level of team or access to that team that can really take them to that level of protection and security for their future generations.
No, that's great. So let me ask you this then. How do you get started? Like, right? Because if somebody's watching this video and they're like, okay, that's great, but I'm not making $1 million a year. I don't have this asset. Like, where is the breakdown? At what point in your life should you start thinking about implementing trusts in general? And then when do you start scaling up the types of trusts, the amount of trusts, or what have you?
So you should think of it as the same way as an LLC.
Okay.
So if you need to create a new business, we were talking about this off camera a minute ago, but
yeah,
if you're creating a new business and you can look at, hey, what are the elements of this business? What's it going to be doing? Is there any assets in here that need protecting? Yeah. Now, they could be held in trust. Let's just say it's a piece of real estate. Let's say it's an office, just so that we've got an example.
Sure.
If you're going to buy an office, it's probably better to have that in the name of a trust and then have the LLC that you own and operate lease that or have some form of agreement with that. So now if someone tries and sues your company, there's no asset there. It's just a company, a shell with maybe a little bit of cash or small fixed assets, but no huge assets. So the building, that's leased by trust number one.
Yep.
It can't come after that. And it gives you a level of protection right from the off. Whereas if that piece of real estate was in the LLC and someone sued you in scenario 2, they could potentially make you liquidate that and take that building.
Wow. Okay. That's so almost like if you have any assets at all, doesn't matter. It's not really income based. It's based on assets in general. If you're buying first real estate investment, if you're buying a first business, if you're anything of that nature, it's not really income driven at all.
Correct. Yeah. So back to what we started with, we talked about asset protection first, right? So the first thing is always going to be protect your assets, whether that's physical assets like real estate or whether it's IP. They're all assets, right? So you should have all of these in separate and trust entities so that they can't be searched and they don't know who the beneficial owners are. It's not public knowledge that. Whereas if you own an LLC as Chris, that is public knowledge. And you own 10 LLCs and people can figure out, oh, this guy's got 10 assets, not one. It can start extrapolating quite quickly, right? So asset protection one, and that can be done through simple trusts. You don't necessarily need the full shebang of the complex trust, because once you get into that complex world, it is more expensive.
Yeah.
And it's like, let's use the car analogy. You can have a Rolls Royce and you can have a Prius, and they're both cars. They're both going to get you from A to B, but they're going to do it in very different ways, right? You're going to
Yep.
have a full luxury vehicle taking you down the road, or you're going to have a basic car that still gets you there, but it's not the same experience, right? You're paying a lot more for one than you do for another,
Yeah.
but it also provides you a lot more as well in terms of comfort, luxury, status. And it's, if you can get it, everyone's on their own path and their own journey. They don't need the Rolls Royce from day one, but as they grow, as they develop, as they start making more money, more profit, or have business needs that need that, then they start upgrading.
Totally makes sense. So from that perspective, talk to me about how do we, how do I put this question? Because it's all about control. It's all about cash flow. It's all about, protection, at the end of the day. And so if, let's say we're starting with assets, right? Like, is it, because it's one thing to say, okay, I'm buying this asset. I want to do, I want to get this trust, and I want to set it up and have the trust that I own or I control by this asset. And that's one thing. But what happens if I already have assets? What happens if I already have 5 rental properties and a business and a building and all that? Can we transfer, like, how to,
Yeah, absolutely. So people get confused about this all the time. So it's a great question. And the deed of a property is different from the loan note that you have on the property.
Okay.
So you can do what they call a quick deed, which is a transfer of ownership from Chris, the individual, into Chris's family trust. And that does not create a taxable event.
Okay.
Because you're not selling the asset. If you were to sell the asset to the trust, that's a taxable event.
Okay.
So you could just go to any quick deed company and say, hey, I own property 1, 2, 3, 4. I want to change the deed of them into trusts number 1, 2, 3, 4. So now I'm fully protected. You can do that, and that doesn't create a taxable event, nor does it change any of the fact that you are still the personal guarantor on that mortgage. It's 2 different things. So people often get confused about it, but it can be done, and it's called a transfer rather than a sale. Okay,
well, that's cool. Okay, so that said, I'm going to pivot to life insurance a little bit now, because owning life insurance inside of these trusts is obviously no brainer. But what happens if what happens if I own a life insurance policy before I start the trust? Can I transfer the life insurance inside of the trust and
yeah, that's just a change of ownership. So that would be a question I would ask you, because
so I can change the ownership. I could transfer the ownership of the policy. So I could do that inside of the trust, and then all of a sudden that's all inside of the trust. And now if we have that ownership shift, now all of a sudden the ownership of the policy gets all the benefits that come with the trust, like all the tax benefits, all the distribution benefits. Like,
absolutely. So the way I'm set up personally is that my trust owns the policies.
Yes.
And I am the person that is what you would call the insured.
Yep.
So it would be the same if you already have an existing policy, you've taken it out years ago, whatever, as long as the terms and conditions in that contract allow you to transfer ownership, which most of them do, as far as I'm aware, then you don't have an issue. Okay. So, and then the beneficiary would be who? Would you make the trust the beneficiary? Yes, the trust would be the beneficiary, because then you get all the tax benefits, right? Because the trust owns the policy and gets paid out when I pass away. Hopefully no time soon, touch wood. Yeah, exactly. But yeah, the tax benefits come in the shape of taking those deductions. So let's just use the $1 million as an example. Let's just say the $1 million went into the trust, and then you took $1 million policy out. So now the net profit of the trust would be 0, because that full amount would be a deduction. You can then take a loan against that $1 million, let's say 80% of it, would be the base that you could take a loan against. So you could have 800K in cash as a loan from the death benefit of the insurance policy to reinvest, as well as making a dividend investment, because it's technically an investment of the trust on the balance sheet of the trust, right?
Yeah, totally. That's great. So I was on the phone with one of my agents earlier with somebody they're trying to help, and the guy that was trying to help was asking. He's thinking about getting policies on all his kids and family members and so on and so forth. But he's like, should I get my trust set up first, or can I get these policies set and then transfer ownership? Is there a reason that you would want to wait? I mean, because obviously the insurance is important, but the trust is important. How long does it take to get a trust set up versus how long does it take to get the policy? So
you could probably start them both at the same time, because these things, with insurance, you have to do your medical, you've got a lot of paperwork and admin to go through before it completes. And the same with the trust world, you've got to do a lot of admin in terms of filling out paperwork and making sure you've picked your names, you've got your EINs, the documents are notarized, like bank accounts are open, like all these things have to be done. And I would say on average, if a client is on top of all of the stuff, we can get things up and running within 2 weeks.
Wow, that's fast.
Yeah, but usually everyone has life that gets in their way, and it's not always as easy as that. So 3 to 4 weeks on average, if a client has their information to hand, we can get them up and running.
But that's pretty standard with the underwriting process for life insurance as well, is 4 to 6 weeks typically. So that's pretty on par. So
that's why it's good that they can run in parallel. It's like, hey, you got to fill out this paperwork, or we get on a call, we'll go over everything that you need, send us some documents, and away we go.
Love it, man. So where do you think is like just the best place to start? Like people watching this are going to be coming from all different parameters, right? We have higher net worth people, kind of upper middle class and middle class, all over the board here. So are there any resources? Do you have it? Like, what do you have going on as far as, I know you work personally with the upper echelon of people, but what do you suggest for everybody who maybe?
The first thing I would do is just go onto our website and do the tax calculator. There's a free tax calculator there that you can just go plug in your numbers. It'll show you exactly how much you could save as a ballpark. And then based on that, you'd know whether it makes sense or not, what we do. And if you need something more simple, you just drop us an email and we're happy to either send you to the right person or show you how to do that. And then the other thing I wanted to touch on, we didn't really cover too much of it, is capital gains tax.
Oh yeah, please.
So within the right type of trust, you can totally eliminate capital gains taxes.
Eliminate,
totally defer indefinitely.
Preach, brother, preach.
So with the complex trusts, we touched about it, and we said it can accumulate income into the corpus of the trust, right? So when you accumulate money in the trust, you can allocate that to future investments. And if you do that, that totally eliminates capital gains taxes. So a lot of our clients are real estate people, or they're selling companies. And if the company is owned by a trust, then when the company sells and the money gets distributed into the trust, we can allocate that accordingly and save them a lot of money on capital gains taxes. That's
amazing. So now that you say that, it actually makes me think of a different question in the insurance space, right? So like, that's awesome. There's one of the things, if you could touch on this, because I know it's a pretty common thing in the life insurance space, is people utilizing spendthrift trusts and spending, 30, 35 grand or something like that to start up a trust and have that own the insurance. But what I've seen is a lot of people do that, and then they get whacked with an audit, and it ends up not passing the audit, right? Like, so I don't know if you have any experience with this and can speak to that at all, as to why that would happen or what the risks are there, because to me, that's a really big deal. Like, obviously, I know some people that have been hurt by it, you know, like they buy a life policy, have it owned by this trust, and then it doesn't work the way that they thought. And I know we talked about it a little bit when we were at the event, but like, this is a massive, massive, massive issue for people who are kind of in that higher net worth space, who are doing it that way and still kind of a little exposed. Can you speak to that at all as to why that happens? Or
Yeah, so you talked about a spendthrift type trust, and again, that's just a marketing spin term. When you dig into it, what does that really mean? The spendthrift is just a provision within the trust, and that means that the beneficiaries of the trust can't sue the trustee and don't have any legal ownership over the assets of the trust. So if the beneficiaries are sued, they can't say, oh, I own this asset that's in the trust, and people can come after the trust. That's what the spendthrift provision is about.
Got it.
So that's got nothing really to do with capital gains tax whatsoever.
No,
So,
it's a different thing.
Yeah, it's completely different. So when we're talking about trusts and capital gains and how it works within the insurance world, the main benefit as a person who writes insurance policies like yourself would be you can mech the policies, because now you can allocate all of those capital gains to the corpus of the trust, and therefore get really aggressive with how quickly those insurance policies pay themselves off.
So between life insurance, like if you mech the policy, the capital gains and the growth inside of the policy, you don't have to deal with the taxes, and you still have the same tax-free access to the capital while it's working, right? So that's
you actually get more because it's more of an aggressive policy between this and the overrides, right?
That's amazing. And so there's two ways cap gains could work well. Is like, even if you had the trust own real estate, you never have to deal with the capital gains from there. So the capital gains on real estate and the capital gains on life insurance, you combine those two different things. I mean, that becomes, especially for the audience that's probably watching this video that I talked to, that's like the biggest no-brainer in the world if you have that. So I think if I recall, what you were saying, well, I'm not even going to say the number. Like, what's the threshold to like really think about what would your tax liability would want to be in what ballpark?
6 figures plus. So if it's like 100K or more, then it's definitely worthwhile at least having a conversation about this. If it's like 200 plus, then it's a home run, no brainer.
So basically what we can do is we can basically eliminate the need for 1031 exchanges with real estate.
Correct.
And eliminate the concern of MEC in life insurance contracts with this.
Yeah.
And this doesn't increase your chances of getting audited or anything of that nature?
No. And even if they did audit, then we've got the full backup, and we also audit. We provide audit defense as part of our services included in our fees anyway, just because we can back it up, and the tax code is all clearly written in 643. So we're not hiding anything. It's written in clear sight. That's
amazing. And so no, that's phenomenal. So one of the things that this is what I'm seeing, and tell me if you're tracking with me, is like, start off with maybe a simple like as you're building, right? Like, as I'm thinking about the life cycle of somebody who's trying to get to the place where they have 6 figures plus of taxes, right? Because obviously that's the goal, to get to the place where we can have that liability and then avoid it. But use trusts to protect your assets as you're building. Utilize life insurance to accumulate cash value, because there's going to be an element of protection for that cash value inside of the life insurance policy anyway. And then when you hit the place where you have enough assets and revenue and tax liability going into it, then you transition and transfer ownership of all these things into this trust. And then you get to kind of like hit the accelerator pedal and take it to the next level.
Yeah, absolutely. You hit the nail on the head. So that's a great kind of trajectory to get into the trust world and really understand it. And another thing, even at the lower levels, is there's no annual fees like there are with LLC. So if you have an LLC in California, you're going to pay $800 a year registration. You've got to pay your city fees. Like, there's a lot of just ad hoc fees that are baked into having an LLC or an entity level here. At the trust level, you don't have those same fees because it supersedes all of that.
That's awesome.
So it saves you, like, if you, as an example, if you had 10 pieces of real estate, you knew you did 10 LLCs and it cost you roughly $1,000 a year per LLC, it soon adds up to 10 grand just on admin fees for.
Oh, it goes up fast. Totally.
Yeah. So being directly in the trust, it removes a lot of those fees and again gives you that level of privacy as well.
Yeah, the upfront cost that would go into the trust would be quickly negated by the annual savings that you have on it as time goes on. That's awesome. Well, that's amazing, KC. I've learned a lot on this, and I think what I'm going to do is I'm going to put a link to your website, to that calculator, in the description below. So anybody that wants to go check out his tax calculator, go down in the description in the link below, click on that link, go mess with it, see if it makes sense. I assume next to that calculator on your page, you have a link somebody can get on the phone with you. And
yeah, on the website, you can just go straight to togethercfo.com.
Okay, I'll put that link down
there. There's a tax calculator right at the top as well. So you can call, text, email, the million ways to get in touch with us.
Beautiful. That's awesome. Well, man, I appreciate your time. Is there anything else we missed? I think we covered a bunch.
Yeah, I think we covered it all. So yeah, we got into high level, and then we can dig deeper in different podcasts after this.
I love it. No, we'll definitely drill deeper in specific areas as we go here. This is not going to be the last time KC is on. I think this topic is so vital. It's one of those areas that at my level of understanding isn't where it should be, right? So that's why I bring people like KC on, and I'm selfishly going to be bringing him on the channel here so I can learn and share it with everybody else as I do. So it's pretty awesome that way. So what I'll do is once again, I'll put the link in the description below. You can reach out to him in general, like just go check out the calculator on his website. Reach out to me if you need anything at all. Chris@life180.com. There's a link down below. You can get in touch with my team. And then we'll go from there. So reach out if you need anything. Comment in the comment section below if you haven't already. I do my best to engage with every single comment, and we'll just go from there. So guys, have a blessed, inspirational day, and we will see you in the next video. Thanks for being here, man.
You're welcome. Thank you for having me.
Take care.